Hello and welcome to another COA webinar on financial education. Today's topic is the fundamentals of investing with Mr. Ash Miner, financial advisor for Morgan Stanley Wealth Management. This is the second in a long series of COA webinars for members regarding financial education, and this comes on several years of Ash Miner's involvement with the USPHS Symposium as an exhibitor and sponsor, and more recently at the 2018 USPHS Scientific and Training Symposium in Dallas as a speaker for the retirement seminar, talking about TSP changes and financial planning advice for PHS officers as they're entering retirement. Today's webinar focuses on the fundamentals of investing. Again, it's sponsored by Morgan Stanley Wealth Management, and today's speaker is Mr. Ash Miner, financial advisor with Morgan Stanley. We have his contact information that we're going to share at the beginning, at the end of this presentation as well. I'd recommend that you follow up with Mr. Miner for personalized advice regarding your financial situation and how you can better plan for the future. Ash Miner, thank you very much for being on the podcast, on the webinar.
Absolutely. Thank you, John, for that introduction. Also, thank you to the COA for allowing me and Morgan Stanley to partner with you over the years. And thank you, everyone, for being on the call today. I know your time is valuable. And over the next 25 minutes or so, I hope to leave you maybe a little better informed, to give you some things to think about, and maybe to help you avoid a mistake or two, to shore up your financial plan and leave you in a better place as you go forward. It's always a pleasure to engage with PHS officers across the country. After all, you are doing to advance the health and safety of our nation, not to mention my own personal family ties to the Corps. It's a great honor and a privilege for me to have this opportunity to help educate and better prepare you as you look ahead to other important chapters of your life and that of your loved ones. To the extent that those chapters involve personal finances, my team and I, based in Charlotte, North Carolina, are well equipped with a process and resources to provide customized advice and planning strategies to work to maximize your outcomes over the long term. To that end, I focus my practice on helping officers take thoughtful action in the near term to solidify their financial lives over the long term, to help define realistic goals and chart a course to bring them into reality, and to have peace of mind in knowing that they've taken wise financial planning actions, or at least know what those actions are so that they can execute on them in due time. Please take note of my website here on the first page. Bookmark it. Take some time to look around on the page. There's a lot of great content posted on there. Also, my email address and phone number. I do invite each of you to reach out to schedule a private conversation if there's something on your mind, or if the content that I go over today strikes a chord as something you'd like to explore deeper as it pertains to your unique situation. And if you'd like to go on my monthly Investor Insights e-newsletter distribution, this is a collection of current articles, educational pieces, and topics of interest relevant to financial planning and a variety of life events. Just please send me an email to be added. I do recognize many of you handle your own financial planning and or you may already be working with an advisor or a financial services firm. Frankly, I commend you if you are doing so. Please consider us a resource, though, and a source of information and general guidance. And if you're interested in learning more about how my team at Morgan Stanley could help you specifically, please know that we're here to help. Though there are Morgan Stanley branches in every U.S. state, my team and I work directly with officers all over the country, so we are able to help you out personally, no matter where you're stationed. Out of respect for your time, I'd like to move through the presentation today and then take questions at the end. Just be sure to jot those down or to use the chat feature there on your desktop as we go along. And with that, let's begin. So welcome to Investing 101, aka the fundamentals of investing, creating and managing a successful portfolio. When I do this presentation in person, I like to find out a little bit about my audience. And I usually ask, what made you decide to attend or to listen in? And I get all sorts of answers. But most people attend presentations on this topic, the topic of basic investing, for the following reasons. They're dissatisfied with the returns they're receiving and wondering if they can do better. They simply feel like they don't know enough to make the right decisions, or maybe they've left investing or other money matters to a spouse or another family member and realize they're just not happy remaining in the dark. Whatever the reason you're here, it's wonderful that you are. Investing is an important life skill that can serve you well at any age or station in life. So investing can be complicated, and yes, it can be overwhelming. And I'm here to try to help demystify the process so that you can make more informed, more confident decisions about your investments. Today, we're going to cover a number of important topics, beginning with the fundamentals of investing. First, we're going to focus on the four major asset classes. These are cash and cash alternatives, fixed income, equities, and alternative investments. We'll also talk about major investment vehicles such as mutual funds and ETFs, which are exchange-traded funds. Next, we'll cover the basic tenets of investing, including the benefits of compound interest, the importance of staying invested, and how market timing can impact your portfolio. Then we'll discuss the importance of asset allocation and portfolio diversification as a strategy to help mitigate risk. And finally, we'll quickly review the key points of the seminar and talk about how your Morgan Stanley financial advisor can help you formulate an investment strategy that is based on your unique goals. So first of all, what is an asset class? Well, an asset class is a grouping of similar types of investments. So there are four major asset classes. Number one, cash or cash equivalents, fixed income, also known as bonds, equities, also known as stock, and finally, alternatives. So the different asset classes behave differently in the markets, and they're associated with different levels of expected investment, return, and risk. And as a result, each asset class serves a different purpose in your portfolio. So let's talk about each of the asset classes in more detail. So first, cash and cash equivalents. These provide liquidity within a portfolio. For those invested in the thrift savings plan, this would be your G fund investment option. Cash equivalents are short-term debt obligations that can easily be converted into cash. Cash equivalents include CDs, money market accounts, U.S. Treasuries, and these typically provide higher yields than a normal savings account. While cash and cash equivalents have the highest relative degree of safety in terms of risk to capital among the three asset classes, their returns may not keep up with inflation over the long term. See, next we have fixed income, and these are bonds. These are kind of like an IOU, if you will. So when a bond is purchased, the buyer is essentially lending money to the issuer, which may be a company, a government agency, a municipality, or a financial institution. The issuer is expected to pay interest to the investor at regular intervals. These are typically semi-annual, in addition to repaying the principal at the date of maturity. Maturity ranges can range from 1 to 40 years. In the thrift savings plan, this would be your F fund investment option. Historically, bonds have been less risky than stocks, but with a lower return on investment. Therefore, bonds can serve the function of providing a steady flow of income for a portfolio. However, bonds tend to be more sensitive to interest rate fluctuations. Specifically, as interest rates rise, the value of bonds tends to fall, and vice versa. There are many different types of bonds, and the level of risk associated with the bond may depend on the issuer. For example, U.S. Treasuries are debt securities issued by the U.S. government through the U.S. Treasury Department. The full faith and credit of the U.S. government guarantees a timely payment of principal and interest on these bonds. And the bond market views these securities as free of any credit risk. Municipal bonds are issued by state and local governments and their agencies, such as water and sewer authorities or public power agencies. These bonds may be backed by the general taxing powers of the issuer, or can be secured by the revenues from specific projects, making them more risky than U.S. Treasuries. Another way to evaluate bonds is to look at their credit quality. Credit quality is a measure of the issuer's ability to make regular interest payments and to repay the principal at maturity. Issuers typically hire agencies such as Standard & Poor's, Moody's Investment Service, and Fitch IBCA, to provide credit ratings on their bonds. The highest credit rating is a AAA. And as you can see from the chart on the bottom right here, bond yields typically increase as ratings decrease. Next, let's take a look at equities. So equities, or stocks, represent a share of ownership in a company. If you own a stock, the value of your shares may fluctuate over time. Because there's more risk associated with stocks, historically, they have provided the most return of the three general asset classes. Over a short time period, stocks can be particularly risky. Typically, they form the basis for growth in an investment portfolio through capital appreciation. This, by the way, would be the C fund investment option in the thrift savings plan. So stocks can be divided into three categories: dividend or income stocks, value stocks, and growth stocks. Dividend stocks are securities that pay regular dividends because companies pass the point of needing to reinvest their profits. Most dividend stocks have lower levels of volatility than the overall stock market and offer higher than average dividend yields. Value stocks are securities that have fallen out of favor in the market and are typically priced lower than the stocks of similar companies. The objective of investing in a value stock is to try to capitalize on inefficiencies in the market price. And growth stocks are securities whose earnings are expected to grow at higher than market rate. Often these companies devote most of their current revenue toward further expansion. And as a result, growth stocks typically do not pay dividends and are selected for their potential capital gains. Finally, alternatives. Alternatives, as their name implies, are assets that fall outside of the traditional markets. There's no available option, by the way, in the thrift savings plan for investing in this asset class. So real assets are tangible assets. These are things like residential or commercial property, and they derive their value from their own intrinsic and inherent qualities. Absolute return assets seek to achieve a targeted return independent of any benchmark or other standard. Equity hedge assets seek to hedge the equity exposure and are usually negatively correlated with equities. This means that they generally generate positive returns in falling equity markets. Equity return assets seek to return above average equity returns through more complex investment strategies. Private investments include investments in private companies or investment vehicles that aim to provide higher than market returns through a longer term illiquid investment strategy. And just want to make a note that investing in alternatives, while it may offer qualified investors the opportunity to diversify their portfolios and help reduce overall portfolio volatility, again, these can be fairly illiquid, and they also do have a heightened degree of risk involved. So next, I just want to touch on what really is one of the most important parts of investing, and that is selecting appropriate asset classes based on your goals. And in last month's webinar, I talked extensively on goals-based financial planning. That is organizing your investment allocations to be most conducive to the accomplishment of your unique short and long-term financial goals. What this slide is, it provides a summary of the 4 asset classes and how they might be used in your investment portfolio. Okay, so now I'd like to take a minute to talk about mutual funds and exchange-traded funds, or ETFs. Mutual funds, by the way, are essentially what the thrift savings plan investment options are classified as. So a mutual fund, it's a portfolio of stocks, bonds, money market instruments, and other assets. These are typically actively managed by professional money managers who are responsible for making decisions on the security selection. One of the benefits of investing in a mutual fund is the ability to invest across asset classes, which might otherwise be out of reach due to minimum account sizes or just high costs. Exchange-traded funds, or ETFs, are investment vehicles really designed just to mimic the daily movement of a market index. Think like the S&P 500 or other benchmarks. While mutual funds typically seek to outperform a benchmark, ETFs just seek to provide the same performance as a benchmark. They're typically passively managed and they don't involve security selection, so they generally have lower fees than mutual funds. One of the benefits of investing in ETFs is the ability to gain market exposure at a lower cost and with more transparency than comparable investment products. However, ETFs may not offer the same level of potential dividend returns as owning the stocks directly. Okay, so next, let's explore some of the basic principles of investing, including common mistakes that investors make. So one of the most important things to remember when it comes to investing is the earlier you start investing, the more opportunity you'll have to grow your investments. And this is why starting early is so important. It's pretty simple, actually. It's compounding. Compounding occurs when the money your investment earns is reinvested, producing earnings as well, or what we call earnings on earnings. The effect of compounding can help a small, regular investment grow large because you have more money working for you over the years. So let's look at this example. And by the way, those of you that were present at the retirement seminar in Dallas this past June may remember this slide. So we have Eric here who invests $3,000 per year between the ages of 30 and 70 for a total of $123,000 invested. Assuming that his investments earn 8% per year, he's going to end up with a little over $842,000 in that account at age 70. Jessica, however, she waits until 50 to start investing, and she invests $6,000 per year between the ages of 50 and 70, again for a total of about $126,000. Assuming that she also earns 8% per year, she's only going to have a little over $300,000 at age 70, and that's more than $500,000 less than what Eric would have. So as you can see, time can really make a difference. Of course, just a systematic plan of investing doesn't always ensure a profit or prevent a loss in a declining market. And there's really no guarantee that your account balance will increase over time. So when it comes to investing, even the most savvy investors fall prey to bias and emotional trades. Movements in the market may make you uncomfortable or emotional, but developing a plan and having the discipline to stay the course can help you avoid common mistakes, such as buying and selling at the wrong time. Another common mistake I see that investors make often is trying to time the market. So market timing can be a timely and costly strategy. Large swings up tend to coincide with large swings down, making it tough to time the market. The chart on the left here demonstrates what happened to investors who simply missed the best days of market performance over the past 27 years. See, investors who stayed invested in the S&P 500 during that entire time frame earned an average annual return of 9.5%. But by missing the 15 best days of performance over the past 25 years, over that period, they earned only 5.8%. By missing 30 days, their performance sank to about 3.4%. So often individual investors going it alone pull out of the markets due to personal fears and emotional concerns about their money, and as a result, they miss these important days in the marketplace. The chart on the right here just highlights that days with large price fluctuations, whether up or down, they generally tend to cluster together. All right, now this chart is showing you the growth of a $100 investment in the S&P 500 over the past 92 years. And what we're emphasizing here is, as you can see, over the long term, the S&P has grown despite economic downturns and geopolitical events. Rather than letting emotions or psychology influence investment decisions or trying to time the market, it may be helpful to consider investing for the long term. This chart shows the cumulative return on a $1 investment in the S&P 500, U.S. small cap stocks, U.S. long-term government bonds, and U.S. 30-day Treasury bills against inflation from January 1926 to March of 2018. During this period, S&P 500 generated an average annualized total return of 10%, as compared to 5.6% for government bonds and 3.4% for treasuries. The take home here is that staying the course and keeping money invested in the market can result in significant returns over time, but it may require a pretty long investment time horizon. Ultimately, going it alone and without a plan can be costly. The light blue bar in this chart on the right shows the long-term return of the average investor in this 20-year period illustrated from 1996 to 2017. As you can see, the average investor's long-term return is only 2.1%, and that is below the inflation rate. So again, we see that stocks show the highest long-term return. But working with a financial advisor can potentially help you just, again, stay focused on your long-term financial goals, take those emotions and short-term movements in the market out of the equation, and it may help you add value to your portfolio over time. Okay, now let's talk about asset allocation and portfolio diversification. Asset allocation is the most important determinant of risk exposures and investment outcomes. Asset allocation is the process of combining different asset classes in your portfolio in varying proportions. Studies have shown that how you allocate your assets is more important than which specific securities you invest in. Establishing an effective asset allocation depends on understanding both risk and return. As we discussed earlier, every asset class has distinct characteristics and may perform differently in response to market changes. As you can see from the chart here on the bottom left, return generally correlates with volatility. Typically, the higher the potential risk, the higher the potential return for an asset class. And the lower the risk, the lower the potential return. Therefore, careful consideration must be given to determine which assets you should hold and how much you should hold in each asset class. Factors that can greatly influence asset allocation decisions are, again, your financial needs and goals, the length of your investment time horizon, and your attitude towards risk. It's critical to consider your goals when making asset allocation decisions, keeping in mind that your goals may change at different stages of your life. If your priority is preserving capital, your portfolio may be weighted towards fixed income, which is kind of illustrated here on the left side. If your priority is growth, your portfolio may be weighted towards equities, more so what you're seeing on the right side of the slide. Now, diversification is another important concept. So what does it mean to have a diversified portfolio? Well, there's three main things to consider here. First, your portfolio should be spread among many different investment vehicles. As we've discussed, each of these asset classes behaves differently in the market. The chart on this slide just kind of shows how investment vehicles from different asset classes correlate with each other. Asset correlation is a measure of how investments tend to move in relation to one another and when. When assets move in the same direction at the same time, they're considered to be highly correlated. When one tends to move up when another goes down, those two assets are considered to be negatively correlated. And if the movement of one asset class really has no effect on the movement of another asset, those two assets are considered to be uncorrelated. So investing in uncorrelated asset classes is key to managing risk and return. The second thing to consider when it comes to diversification is picking investment vehicles that vary in risk and return. Picking different investments with different rates of risk and return can have a positive impact on your portfolio. Let's take a look at this chart. The portfolio on the right includes only stocks and bonds. The portfolio on the left includes a mix of stocks, different types of bonds, and some alternatives. This more diverse portfolio has the potential for not only lower risk, but also higher returns. The third thing to consider is diversifying your securities by industry and geography. The so-called lost decade, that period from 2000 to 2010 demonstrates the importance of global diversification and asset allocation. As you can see, during that lost decade, globally diversified indexes significantly outperformed the S&P 500. Now, having the right asset allocation will ensure a diversified portfolio. This messy slide here shows the best performing types of investment each year over the past 10 years. So as you can see, having a diversified portfolio helps ensure a balance of risk and return. I hope this introduction to investing has given you a deeper understanding of the fundamentals of investing. Before we wrap up, let's review 5 key takeaways. Number 1, different asset classes behave differently in the markets, and they're associated with different levels of expected investment return and risk. As a result, each asset class serves a different purpose in your portfolio. Number 2, time is money. The earlier you start investing, the more time you have to take advantage of the power of compound interest. Number 3, staying focused and staying in the market may benefit you in the long term. Keeping money invested in the market can result in significant returns over time, but it may require a long investment horizon. Number 4, asset allocation is the most important determinant of risk exposures and investment outcome. And finally, diversifying your portfolio by asset class, by security, and by industry and geography can provide better risk and return opportunities. Just want to thank you all for your time and attention. I recognize there are other ways you guys could use the last half hour, and that you spend it with me just pleases me greatly, especially if I gave you even one little bit of info that might leave you in a better position now and in the future. As a financial advisor who's been in the financial services industry for more than 16 years, I've had the opportunity to help many individual officers and their families develop customized investment strategies that help them achieve their goals. I focus on helping clients make informed, confident decisions about their investments, and I'm happy to help you too. I invite you to give me a call, office or cell, and yes, you're welcome to send me a text if you have questions, or email me to schedule a time to connect. I look forward to engaging with you and helping you take the next step toward achieving the retirement you've always wanted for yourself. Thank you very much. John?
Mr. Ash Miner, Financial Advisor for Morgan Stanley Wealth Management, thank you very much for being here on this COA webinar for the COA members on financial education.
My pleasure.